After a global pandemic hit on May 2nd, Berkshire Hathaway, Warren Buffett's conglomerate, reported a net loss of $50 billion, proving that not even the most brilliant financiers are protected from the unexpected. The company has reported a profitable quarter, but its stock price has not yet recovered to levels seen before the pandemic. Buffett lost his position as the world's third richest man. It turns out that even people like Elon Musk, who initially appeared light years away from Buffett's level, have now surpassed him. Regardless of how intelligent, talented, or diligent you are, the market is unpredictable. Moreover, it is possible to completely ruin one's financial situation under the delusion that one has discovered a way to become independently wealthy. While there is a seemingly endless variety of mistakes that investors, especially novices, make, there are five common errors that even experienced investors sometimes make. Take this in and hear it. Confusion between investing and trading. New investors often assume that you must constantly be on the lookout for hot stocks or stocks with high potential for growth. And if you've gone an entire month without investing in a single company, you are not an investor. There are two types of people in the stock market: investors and traders. Rather than buying stocks as a long-term investment, traders buy and sell them frequently in order to capitalize on price fluctuations in the market. Have you ever seen how quickly stock prices can fluctuate? They jump and down every minute, if not every second. The price starts at $100 and ends at $105. Therefore, if you invest $100,000, you can anticipate earning a daily profit of $5,000. Theoretically, it appears to be a simple way to earn money, but in practice, it is considerably more difficult. Predicting stock prices in the short term is extremely difficult, and as a trader, it makes no difference what stocks you buy, even if the companies are total scum, because you are not looking to keep your money there. And this is what distinguishes it from investing. When you invest, you buy a stake in a company with the expectation that it will produce a return for you over time. So, if you know a company is doing well and you know where it will be in 5 or 10 years, you might keep investing in that company instead of reading. Unless you want to waste your time analyzing endless financial statements. Emotional investment. When the price of a particular asset rises dramatically, a large number of people who were previously uninterested in investing become interested. People who had no idea what cryptocurrencies are, how blockchain works, or the underlying technology began purchasing bitcoins in the hopes of making a fortune as the price rose dramatically. Remember the mortgage crisis as another example. Even the most qualified investors were unable to resist and enter the market. However, the entire system collapsed, and some nations continue to feel the effects of that crisis. Mark Cuban was astute enough to sell his entire stake in Broadcast.com before it collapsed in the late 1990s, when even a tech giant like Yahoo made the disastrous decision by investing several billion dollars in the company. Here's a general guideline. If it's already making headlines and trending up significantly, you can consider the opportunity lost and move on. That cycle may have reached its apex by the time you arrive. Reasonable, calculated risk is required for any investment you make. Yes, you may miss out some great opportunity, but you will avoid the risk of losing your entire portfolio and build a sustainable one over time. The greatest investor in history, Warren Buffett, passed up opportunities to put money into Google, Amazon, and many other successful businesses. There are two kinds of stocks to consider purchasing. A stock of a company with a promising future whose current stock price accurately reflects its value today, not in 5 or 10 years. Second, a stock that is undervalued for one reason or another. Everything else is most likely not worth your money. Waiting too long to get going. Time is everything when it comes to investing. The sooner you invest, the more you will earn. $100 invested when you are 20 will grow to $466 by the time you are 40, whereas $100 invested when you are 30 will grow to only $215 by the time you reach the age of 40. That's assuming you put it in an index fund with an annual return of 8%. You may be thinking, let me wait until I have everything figured out. But that time will never come. Inevitably, there will be details that elude your understanding. That may sound controversial, especially since I just advised against investing without first doing your homework. You don't need to be a financial whiz to get started, but that is true. An index fund is a good choice if you're not very knowledgeable about the stock market. Begin with a small portion of your savings or monthly pay and then give yourself time to learn. You can then use your newfound knowledge to invest in companies you anticipate will outperform the S&P 500 as a whole. I understand that you may be pressed for time, but you don't have to waste your time every day spending hours and hours searching for businesses. A minimum of once per month and preferably twice is required. And when you do, keep putting your money there. The stock market and real estate are two of the most exciting places to put money. But that doesn't mean they're the best places to put money. The market can only provide a maximum of 7, 8, or 10%. Of course, it varies from year to year because there have been times when the S&P 500 was up by 20% while other times it was down by a negative percentage. However, when it comes to a small investment in a small business, that appears to be working. Returns can range from a few 100% to thousands of percent. You can have an effect on it, unlike these multinational corporations over which you have no control. Don't let the stock market fool you. The best investment opportunity for you might be right in front of your eyes. Investing money you don't have. Getting excited about investing is easy. You can see all of these figures. You're eager to get started right away and achieve success in order to increase the value of your money or to acquire more green bills. However, before you invest your money, you should think about other factors as well. There is no point in investing if you will need the money within the next few months to pay for necessities. This is why. Due to the unpredictability of the market, even a large and stable company will likely grow over the long term. However, in the short term, the stock price may fall, and if you suddenly need money to cover your basic expenses, you may be forced to sell your investments at a loss. Don't get carried away. Obviously, you should begin investing as soon as possible, but be sensible about the amount you wish to invest. Even if it's only a few $100s a month, it's preferable to begin with a small but consistent investment. If you are new to investing or extremely interested, please take these errors into consideration. We hope you found this video helpful and educational, and we'd be happy to provide you with more like it if you're interested. Please subscribe and do not forget to hit the like button. We'd love to see you at the next one. Thank you very much, guys.